welcome everybody to our Bay Area Housing Market Town Hall. Today is May 18th. Before we start, as always, I want to encourage everybody to subscribe so you get notified as soon as the recording is ready to be viewed. And I don't know if you guys know that this month is Asian Pacific American Heritage Month. And I want to celebrate this not only because we are Asian Pacific American heritage. I feel like, of course, especially I came from Hong Kong. I immigrated here when I was 18 years old, coming to United States. So that heritage to me is really important. And I want to introduce you to our team as well. What's unique about our team is that even though, as you can see, we have a lot of Asians here on our team. We have Chinese, we have Koreans, we have from Hong Kong or from Philippines, but then we also have Jose, he is from Ecuador. And also we have Lindsay as well. And when I created our company, HAYLEN, I always say that I want my company to be very inclusive. And I want people to see us as not just like, oh, they're Asian companies or they're Asian realtors. We are realtors. We are professionals. All the people who are teamed together, we all have the same objective to really help our clients, to really educate them and inform them, and making sure that when they buy their properties or when they sell or when they invest, they know what they're buying. So we're not here just to make a sell out of you, but we want to educate you. So I think we all got together, not because of our background or in terms of like our ethnicity, but it's because of our objective and also a purpose in real estate. But we still need to celebrate our heritage because we all came from different backgrounds. And that's what I love about the United States, because there's just so many different people, so many different cultures that we get to learn from each other. So, and I want to invite you guys, if you want to learn more about our team, you can follow us on Facebook, LinkedIn, or Instagram. Our team definitely, we try to share as much as possible with everyone. So feel free to follow us on social media. Before he starts, I just want to introduce Oscar to you guys because I'm super excited that, he's the Deputy Chief Economist at the California Association of Realtors. And our association have more than 200,000 members. He co-manages the research and economic department and oversees the operation of data analytics and survey research within the division. And as an economist at C.A.R., Oscar provides regular updates on the economy, state and regional housing markets, consumer behaviors, and public policies issues. He has written articles and reports on subjects including housing supply, affordability, mortgage finance, homeownership, tax reform, and other topics related to the real estate industry. All in all, he is an expert. So welcome, Oscar, and thank you so much for being here.
Thank you, Helen, for having me. A lot of good information. I think you share a lot of good information about the the Bay Area, and I can tell you that the numbers that you showed that you have shown so far, they're pretty consistent with what I have, for April at the state as a whole. Now, what does that really mean? I'm going to talk about it, and I'm glad that many of you are somewhat realistic in regards to interest rates. I don't see anyone that says who said it's going to be 3 or 3.5, which is good. We got to be realistic about what's going on. Let's get started with the macroeconomics. Now, Helen, thank you for sharing all those data. I can use those data as background information. But let's take a step back and let's take a look at the overall economy, because at the end of the presentation or at the last 10 minutes or so, we're going to go back to the housing market, and then we can wrap everything up with what I'm going to talk about in the next 15 minutes or so. But let's get started with the overall economy. Now, this is not the slide that I'm showing right now. That's a topic maybe 2 years ago, people were not very, very familiar with it. People know that what inflation is, but it was not in a lot of people's radar because, usually inflation back then was 2%, not a whole lot to talk about, especially since it has not been affecting interest rate that much. But let's take a look at the slide. Let's take a look at why recently, in the last year or so, we have been talking a lot about inflation, because that is actually a very important concept. That is a very important variable that actually has been affecting our economy right now. Take a look at the slide on the graph on the right-hand side. you can see that I have inflation going back to 2010. And if you look at that blue line right here, you can see that it fluctuates, but it has the highest that we saw back in July 2011 was maybe 4%. In the last, or actually this is the percent change in CPI, but in the last 3 or 4 years or so, average, if you look at that green line right there, it's pretty consistent. The core CPI, let me make the distinction. The core CPI is the CPI is the consumer price index. And that is the measure that we use to measure inflation. Now that number, core CPI, is a number that takes out the food and energy. Those are the items that are most volatile. So when you take out all those stuff, that's what we call the core CPI. And you look at the core CPI number, this green line, usually it's around 2%-ish or so. 2% is not huge. But you can also see that right around here, now during the pandemic shutdown, we actually had a dip. We actually dipped down to about 1% because a lot of people they were not sure whether how the economy is going to do. They're going to put their stuff on the market, not housing, but they're going to put their stuff on the market to sell. Retail store tried to sell their inventory, and so prices actually have not been that high during that period of time. But then, of course, things started getting a little bit better. We can order things online through Amazon, and we also started seeing some supply disruption, which I'll explain a little bit later. Then you started seeing this green line started rising. Now the headline number that you usually hear from the news, from newspaper, this is the number. And the latest number that we saw last week was 8.3%, meaning the headline inflation actually increased by 8.3%. The core inflation, even though it's a little bit lower, it's still at a 6.2%. So it's still bigger than what we saw 2 years ago during the pre-pandemic level. Now, there are some silver lining to it. 8.3%, the latest number, is not the highest number. The number that we saw a month ago was 8.5%. So that's great. We're seeing some slowdown, and that's why a couple of weeks ago, when you look at the stock market, after the news, even though the headline number looks really high, it started actually coming down. Started feeling a little bit easy because it looks like things are actually going in the right direction. But let's remind ourselves, 1 month doesn't really make a change. So you have to remember that even though we are seeing a slowdown by 8.3%, it's still an 8.3%. And the core inflation is still 6.2. Now, if that trend continues, then we have we will be a little bit more optimistic. We can be a little bit more optimistic then. But before then, let's just observe and for another couple months or so. Now,
Oscar, can I ask you a question regarding that?
Sure.
So in terms of we're seeing still 8.3 is still really high, but then the interest rate, or I should say the Federal Reserve, starting to raise rates, right, in March, April timeframe. So the numbers that we're seeing, 8.3, is still kind of a little lagging. We're probably not really seeing the current effect of what the Federal Reserve has raised rate that much yet. So we're trying to see the trend to make sure that it is going down and they're doing what they're supposed to do, then the market will react accordingly.
Right. Now, the Federal Reserve, the reason why, and I'll explain to you a little bit more in detail a little bit, but the Federal Reserve raising rates, yes, it is to control inflation, absolutely. But the effect of high interest rates actually you may not actually feel it until a little later. So, we're seeing a slight slowdown from 8.5 to 8.3. We anticipate a little bit more. Now, there are other reasons that counteract the Federal Reserve, which we'll talk about in a few minutes. But those affect, in terms of inflation, if you take a look at the slide on the right-hand side, or the two slides on the right-hand side, you'll see those are a prediction by UCLA. If you look at the top one, that's the overall, the headline number. The bottom one is the core CPI. In UCLA, this was predicted at the end of the first quarter. So at that time, they probably already knew that the Federal Reserve will raise rates. Now, they probably didn't know how aggressive they were going to be, but based on UCLA, they expect the second quarter number to actually start going down, and then go down again in the third, and then finally in the fourth quarter, and continue to go down in 2023. So for you, from UCLA economists, from UCLA Anderson School, they do predict that things are going to actually start going down. Now, let me remind you though, this was predicted at the end of the first quarter. I would say, and they will be coming out with their second quarter number probably in about a month or so. I bet that those numbers are probably going to go up, because at that time, now of course, they did not expect inflation to actually flare up to about 8.3%. At that time, UCLA probably saw a 7% or 7.5% in February, and they thought that might be the peak. I thought that would be the peak either, but at the same time, it's a little tough because there have been a lot of uncertainties. So before we get to the uncertainties, these are some of the breakdowns. If you look at the inflation expectation, this is expectation from consumers, and that's based on the New York Fed survey. This was what people saw. Gas prices, when compared to the previous year, it increased by 5.2%, which is actually not too bad. It's actually increased a lot more. But if you take a look at some of the other items, food items increased close to 10%. Look at college education to another 9.1%, and rent 10.3%. Remember this number? I'll talk a little bit about it later on. So a lot of the items, it's not just gasoline, have been increasing. A lot of items have been increasing. And why are we seeing some increase in prices? That's because of, in general, the inflation or increase in price is because of, well, you guys have been in the housing market, it's the same concept. It's because we don't have enough to supply to fulfill the demand. Same thing for everything in the economy. There has been some supply disruption during the pandemic. Now, during the pandemic, and it has been ongoing for a while, it's all over the world. In Asian countries, there have been a lot of factories shut down because of the pandemic situation. A lot of people couldn't go back to work because of that reason, but also because of the implementation of some of the public how should I say it? The public I forget the word, but they have to implement the
Is it public policy?
Certain policy in order to make sure that public safety or public medical concern are addressed. So all of those implementation lead to some delay in supply. That actually is for if you go to a supermarket or during a pandemic, when you go to a supermarket, you have to put on masks. You have to make sure that they have to make sure that plastic, glass are being in place so that they can actually carry out the transactions safely. So a lot of those implementation led to or result in a delay in supply. And if you take a look at the slide on the left-hand side, the supply delivery time, as expected by different companies around the world, suggests that in 2020 and 2021, actually that delivery time has been increasing. Now, if you look at the projections on the right-hand side, though, a lot of people, knowing that the supply delivery time or there will be a delay across the world and in the U.S., they notice that they also predict that in the upcoming year there will be supply disruption as well. So if you look at those bars, the green bar shows you the shipping delay time, and the production is the red bar suggests the production delay time. So this is a survey, the right-hand side. These are a survey of corporate or firms that believe there will be an end to the production delay or the shipping delay in that particular quarter. So if you look at the 2022 first half of the year, a lot of people believe those shipping delay and production delay will end in the first half of 2022. Now, but if you look further, you realize actually a lot of people believe it will happen in the second half or maybe even after 2022. Why is that the case? That's because they already observed what's going on in the last half of 2021, and they noticed that yes, it's most likely the supply disruptions will most likely continue in 2022. Now, this is before the survey was taken before the Russia-Ukraine geopolitical tension, and also before the zero COVID case shutdown in China. So this actually, the results here actually may show a more positive side. You know, if it were to be taken today, the survey would actually push, the survey results actually will show something a little bit different. It actually will push some of those supply disruptions or production delay a little further out. So when you have those supply disruption, what happened? It increased, your price on supply, and it leads to, more inflation. Now, what else led to more inflation? The Ukraine and Russia conflict that started taking place in March. Russia and Ukraine, while Russia turned out to be one of the top countries that export oil to the global economy, and because of their Russia-Ukraine conflict and geopolitical tension, which resulted in a lot of tragedy, a human tragedy, but also, it resulted in a lot of economic impact. How? It actually pushed up home prices significantly. You guys felt it, have been feeling it at the pump. So you have high oil prices. High oil prices lead to more inflation, but it's not just energy prices. I'll show you in a minute, there are other commodities as well. So when you have higher inflation and higher oil prices, and you don't know when it's going to end, that creates a little bit of market turmoil. Now, at the beginning, it was the uncertainty about the geopolitical tension that caused the financial market to fluctuate. But lately, it's about inflation. It's more about inflation because people started realizing that this may actually be a little bit hard to control. And what happened when you have inflation? You also have interest rate volatility. Because and I'll explain a little bit further in a minute. When you have inflation, the Federal Reserve will actually try to control interest rates to make sure that the inflation is kept under control, and that actually could lead to a slow economic growth. Now, what are some of the items that actually are being the prices have gone up? When I said oil prices, yes, oil prices have gone up. If you take a look at the wholesale Brent oil in the world, in March, it actually went all the way up to 130 before it's coming back down. But it's not just oil. Natural gas also have increased. Take a look at this slide right in the middle. And of course, coal, which is what a lot of people use to make energy, also shot up significantly. Those are some of the items in the energy sector. What about the commodity prices? Russia and Ukraine, they actually have been supporting the world with about 30% of the wheat product. When, because of the sanction, because of them being engaged in war, that actually resulted in increase in wheat prices. A lot of food products are based on wheat, so those have increased significantly. You wonder why food prices have gone up. That's part of it, but there are other commodities as well: nickel, platinum, gold. Those actually increased quite significantly as well. Take a look at wheat prices, increased by about more than 80% in terms of price. So a lot of things have gone up. The inflation that we have been seeing, those are real. It affecting our food prices, it affecting the material prices. What else? What else affect inflation? You probably have heard that on the news also. There has been a labor supply shortage. This chart shows you, how many jobs we have. This is job opening. This is the number of jobs plus the job opening. And, this is 2019 going all the way to the pre-pandemic level. Now, if you take a look at these charts, these bars, they have been pretty consistent, right? Yeah, have been increasing a little bit throughout the 2019 to 2020, pretty consistent. But take a look at what happened. It plummeted, because of what? Because of the pandemic. We had a shutdown. We had a shutdown that cost us the recessions, but it started building back up, which is great. In the last 2 years, we actually started building back up. And if you look at this level, it's actually surpassed what we had in terms of jobs and job opening back in 2019 and back in the pre-pandemic level. So that's good news. We have more jobs, we have more job openings. The bad news is, take a look at the green line right here. That's how many people working or looking for a job. Now, before the pandemic, it's been pretty consistent. Then it dropped. because of the pandemic, because of the shutdown. It started coming back up. That's great. But, even as of today or the latest month, this number is still below the pre-pandemic level. Even though we have more jobs and job opening, we still are not getting back, as many people to work in our economy. Now, there could be a lot of different reasons. It could be because, people have been out early on. It was because people are concerned about COVID. They didn't want to go back to work in terms of in the service sector. Now, later, more recently, it might be because some people retired during the pandemic. They are not coming out of the retirement. Some people who are so used to working from home now, they're concerned about traveling, 2 hours to the work, or they're concerned about, their not having anyone to take care of their kids. Whatever the reason might be, there are fewer people who want to work now. Now, there could be also another reason, some people turning into entrepreneurs. They decide to go do their own business. But whatever the reason is, we actually have a shortage. That's the number of jobs plus job opening we have, and that's the number of people we have in the economy. Labor shortage would lead to increase in wage growth, which is great. But if wage growth is actually not as high as inflation, that means you're actually earning enough. That's the reason why the Federal Reserve needed to do something, and they started raising Fed funds rate. Now, by raising the interest rates, Federal Reserve is what they're trying to do is to lead to a higher cost of borrowing, and so that will actually lead to the economy slowing down a little bit. They're trying to control the demand side rather than the supply side, because they can't really control the supply side because, well, people are not going back to work. Or, if there is a supply shortage, you have to wait until, other countries started, boosting their supply, wait for, for China to actually lift their zero COVID cases policy. And of course, wait for Ukraine and Russia to end the war. But for the Federal Reserve, they can actually slow down the demand so that there will be a balance between supply and demand. So they start raising rates. They already raised rates 2 times, one at 25 basis point, the other at 50 basis point. So far, we're at 75. The cap of the high end of the target rate right now is at about 1% or 100 basis point. So, question that people ask: are we going to see how high is the Fed funds rate going to go up to? Do we know? Do we know how much interest rate is going to be increased? Let's take a look at this chart on the right-hand side here. This is the projection of the federal officials. They do their projections every few months or so. The gray bar right here, that shows you the projections that they had at the end of 2021. At that time, they believe that different officials have different projections, but the median is right at this line right here, this white line right here. At that time, their projection was collectively, by the end of 2022, we will be at 0.75. Obviously, they changed their projections. Look at the green bar right here. The green bar is their new projections 3 months later. They now believe, or at least they believe in March 2022, not the 30-year fixed rate, but the Fed funds rate is going to be at 1.75. Now, right now, it is at around 1 or 100 basis point. If you look at that range of projections, at the end of the year, they're going to go up to 175. That means the Fed funds rate will be at least increased by 75 basis point. They are going to raise it again in June by 50 basis point, and maybe 25 basis point between June and the end of the year, maybe more. Their projections in March probably is a little underestimated right now. So there is a chance that we may actually go up a little bit more. So Helen, your question about how much we are going to see interest rate go up to, if you look at this chart, if I actually show you this chart earlier, maybe there is a different estimates, but I think, and I didn't participate in the poll because I want to show you the chart. I think it is going to be, if Fed funds rate is going to go up to about 1.75, which I think is a little low, I think it's probably going to go up to either 2 or 2.25. Then you add in your, there's a spread between 30 years and 10 year, the target rate. We're probably looking at somewhere at the end of the year, probably somewhere around 6 or 6.25, which I believe someone actually guessed.
Yes, we did.
6.25-ish or so. Now, for the year as a whole, the number that you show earlier, I think from NAR, from Freddie Mac, and from Fannie Mae and MBA, I guarantee you that they would have to change those numbers.
I agree.
Well,
as we have seen that they do change their numbers every few months or so, right? And it looks like Ilana is the one who got it the closest to your projection as well.
Good job, Ilana. So we are seeing, we do expect the rates to increase by, to 6.25. Now the question I think many people ask is, well, if the Federal Reserve are going to increase rates by, let's say, at least 75 basis point or maybe even 100 basis point, should we just add on that 100 basis point to the current rate that we have right now as 30-year fixed rate? Now, 30-year fixed rate right now is what average, I think, depending on what source you use. The Freddie Mac's number actually came out at around 5.3. But if you look at the Mortgage News Daily, it's more like 5.67 or whatever it is. If you tack on that 100 basis point, it's closer to 6.5% or maybe even 6.75. But a lot of the Fed funds, the Federal Reserve have been pretty transparent. They have been letting people know we are going to raise rates. So the 5.5 that we're seeing today may already have some of those Fed funds rate target increase taken into consideration. So the increase from this point on, 5.5 to whatever the rate is, probably will be a little bit slower compared to what we saw in the first 3 months of the year or 4 months of the year. But all bets are off if we have inflation flaring up again. I'm hoping that inflation will actually start coming down a little bit. Now, this is the number, as I mentioned, it depends on whether you look at Fed funds, Freddie Mac's number or Mortgage News Daily. Mortgage News Daily, I don't have to, I think it's in the last few days, it started actually slowing down a little bit. I don't have today's number, but it actually came back down a little bit. I think in the last 3-4 days or in the last week or so, it's kind of fluctuating a little bit. It really depends on how high inflation is going to go. Now, it also depends on, in addition to inflation, the Federal Reserve also need to be concerned about the economy. If they raise the rates too fast, the concern is, yes, as I mentioned earlier, they raise rates so that they can actually slow down economic growth so it won't get overheated. But they don't want to slow it too fast, because if they actually slow it too fast, that means we are heading towards a recession. You might have heard already. People are concerned about recessions, and that's one of the reasons why we're seeing some fluctuation in the stock market. Why do people think that we're heading into a recession? Well, there are a lot of different reasons. One is, there have been some signs. Some of you may know what the yield curve is. To put it in a very simple term, the yield curve is the 10-year yield minus the 2-year bond yield. The difference between the 10-year and the 2 years, that's the yield curve. And typically, when you have a long-term loan, like a 10-year, long-term bond, 10-year, the interest rates or yield on that is a little bit higher than a shorter-term yield. Why is that? Why? When you loan someone just like a 30-year versus 15 years, when you loan someone a 10-year loan, you have a little bit more risk, a little bit more uncertainty because it's the duration is a little bit longer. 2 years typically is a little bit lower. But what happened when you actually have a negative number? That's what we call the yield curve inversion. And that's when the 2 years actually is bigger than the 10 years. Why do you think 2 years is bigger than 10 years? That's because people think it's a short term is very risky. That's because people think there is a recession in the short term. And that's exactly what happened, about 2 months ago when we actually had a yield curve inversion. It dipped for about 2 days. 10 years minus 2 years actually dipped below a negative number. It's right here actually, before bouncing back. Now, right now, not a lot of people talk about yield curve inversion, at least in the last few weeks, because it hasn't been below zero. But we are seeing some of the signs. The GDP number, the first quarter number, actually show a negative compared to the previous quarter. That's a concern. But let me step back a little bit. Yes, we saw a drop in the GDP in the first quarter, but the reason for that is there are a lot of components to add to the GDP. One of the components that is accounted for is what we call the net import-export. The net import-export is if we actually buy more than we export to other countries, and that number is a negative number, that is going to counteract, all the domestic economic activity that we have. And that's what we had in the first quarter. We have a large number of negative import-export. So the other countries have not been recovering as fast as we do, and that's why we have been importing stuff from other countries. And that actually led to a negative GDP in the first quarter. Now, technically, the technical definition is if we have 2 consecutive quarters of negative number, that would be considered a recession. Are we going into a negative number in the second quarter? I don't think so. I doubt it. But there are a lot of different reasons to believe that might be. And in fact, if you take a look at the chart on the left-hand side here, many economists were asked whether we are going to recessions. At the beginning of the year, only 15% said that we are going into recessions in the next 12 months, but that number has increased to 33 or 35%. So more people believe that it is going to be we're going to have a recession. And the reason why, because the Federal Reserve, many believe that Federal Reserve will increase interest rates at least 2 times by 50 basis points. I think that might be even higher now. Now, what about the real numbers? What are the real numbers telling us, at least for the second quarter? This is the retail sales number. This last column, April number, shows you, whether the retail sales are actually improving or decreasing. If you look at this very first number on top, the very top line, on the retail sales on a month-to-month basis, we're actually improving by 0.9%. Not bad, not the greatest, but not bad. But let me remind you though, these numbers, they do not take into account of inflation. The real retail sales numbers, if you actually look at the month-to-month, the real retail sales number actually is not too bad because we did have a dip in gas prices from March to April. But take a look at this number. This is the real retail number compared to a year ago. That actually shows a negative. So the real retail sales number compared to a year ago, we're actually not great. And some of you may have noticed yesterday and today, Walmart and Target actually announced their quarterly result, the first quarter results. Take a look at what their prices how their prices have been doing, and why people are concerned. Both Target and Walmart, one of our biggest, two of our biggest retailers, both dropped in terms of their share prices because it was disappointing. So that's why people are concerned. Now, consumers are still confident about what's going on. They're not as confident as 2 months ago or 3 months ago, but they're still at a level that is, pretty decent compared to, let's say, pre-pandemic level, compared to not as high as 17 and 18, but it's still, pretty decent. So consumer confidence, but consumer confidence usually line up with the stock market. So if the stock market starts rising or dropping, that's when you see consumer confidence dropping or rising. Now, this is our predictions. This is C.A.R's predictions. I have to say our number is probably a little bit more optimistic. I haven't changed the number for a couple months already. I think this number should be a little bit revised downward a little bit. but I won't have the official number until a little later. Most likely it will go down to maybe about 2.5% or 3%. Inflation, which is a CPI number, take a look at the number. It's actually at 6.1%. That's actually pretty high compared to before. Now let's talk a little bit about the housing market. I know I'm going a little over time. I apologize for that. So when you have interest rates rising, the Federal Reserve are increasing their interest rate, what's going to happen? Well, take a look at right here. That's only up to April. Compared to a year ago, we're almost 200 basis point higher. Take a look at this chart on the right-hand side. When you have a difference of about 200 basis point, your mortgage payment actually increased significantly. This is your mortgage payment compared to a year ago. The monthly mortgage payment increased from the year before by about 36-37%. Now, your buyers probably did not increase their income by 36.7% from a year ago. That's a little tough. Now, part of it is because of home prices, part of it is because of increase in rates. But take a look at the income. Now, I know in the Bay Area, this number is nothing. But we'll let the more accurate number, maybe this one. Yeah. If you look at the Bay Area number, the household income in the first quarter that requires to buy a median price home, just a median price home, is about $270,000. Now this is at maybe about 4%, 4.5%. This coming quarter, second quarter, I'm pretty sure that number is going to go up to 300,000. It's still a very, very, very high number. I know. Again,
I mean, again, that's why I always say that when the rest of the country look at Bay Area, they're gonna be so shocked to say, like, who makes $300,000 a year in order to afford a house in the Bay Area?
Exactly. Well, I haven't shown you, the San Mateo number. San Mateo number is close right now. It's already over 300. Is next quarter or the second quarter, it could actually hit 400. Now, that's the reason why I want to show you this chart, which is pretty consistent with what, Helen, you just showed in your presentation. You showed a lot of different counties. They actually dropped in terms of sales, or sales as of through the 18th. I'll tell you that based on the pending sales number, those are real. This is April's pending sales number, open escrow number. It dropped 25% compared to a year ago. Last time we actually dropped 25% on a year-over-year basis was 2 years ago in April 2020, which is when we had a shutdown. So now, it's not going to drop 25% on closed sales, but I think even if we drop about 15% closed sales, that's probably going to lead to a sales number that we haven't seen for a year and a half or so. So we are going to see some slowdown in sales. I'm not going to sugarcoat it. We are going to see some slowdown in sales. Now, why are we seeing some slowdown in sales? I think, Helen, you already mentioned a few things, but I think look at it from this 10 point. Some of the closed sales numbers that happened in April, people actually opened escrow in March, and in March for conforming loan, 30-year fixed rate at that time, people were still able to lock in at maybe about 4%-ish or so, maybe 4.25. Fast forward to April, if people open escrow in April and close in May, the lowest they can actually lock in without going into adjustable rate mortgage, most likely they have to lock in at even 4.75 or maybe even 5%, depending on what period, when you actually lock in your rate in April. I think 5% or 4.75 is the threshold. People look at that number and say, I may not be able to afford that, or let me hold back. So I always tell people, 6 months ago or a year ago, I'll tell people, well, this is a good time to buy because look at it from this standpoint. For the buyers, there's no reason for them to actually not buy, because The only reason why people hold off is they think interest rates are going to come down, or they think that prices are going to come down. A year ago, if you look at interest rates, 3%, people would not think that interest rates are going to come down. Or if they look at, because it's already at a very, very low. But if you look at prices, they may think prices will go down, but it has been going up. So that's why they say they will convince themselves to actually go back in, because prices, yeah, it's high, but it's not going to come down. Today, it might be a little different. They may look at the rate at 5.5 and think rates are going to come down. They may think that way. And when they look at the price, they may think prices are really high. It's really hitting record high now. And I've been hearing that, things are actually slowing down. Let me hold off. I think that's the reason why we're seeing, people holding off right now. Now, in reality, is that going to be the case? I think some of it could be self-fulfilling prophecy also. When we go into the home buying season, if a lot of people actually believe that, okay, well, we should hold off, then sales actually could be hold off. But I'm going to say this: I do not believe that prices are going to come down. I do believe that prices. Let me rephrase it. I do not believe prices are going to come down from last year. I do believe that it's going to come back from the peak. So yes, it's going to come back from the peak. I mean, seasonally, that's usually the case anyway. We usually come back down from May to to a low price anyway. But compared to a year ago, probably not.
So this is actually, I think that this is what a lot of people want to know and wanted to hear, is that, okay, so when is the mortgage rate is going to come back down, and whether the prices have come down. And I had the same opinion as well as you, is that I don't think the price is going to come down from last year's level, but we definitely had peaked, as we have seen probably around April timeframe. And now this period of time where people are not looking, as I mentioned earlier, a lot of open houses are pretty empty. This could be an opportunity for some buyers, because now you get that leverage to negotiate. The interest rate is still going to go up for the next few months, or even until next year. So, but then there are going to be buyers come back probably around January, February of next year, come back to buy, and then the price is probably we're not going to see that 16%, 18% increase anymore year over year change, but we're probably still going to see some single digit positive number from the year before. That's how I interpret the market. Do you see it that way as well?
So I agree with you. So let's talk about price first. Price wise, yeah, either this month, April or May, we'll see a peak price, the record price. From this point on, it's going to slow down from the peak. Now, compare on a year-over-year basis, which is what we normally use as a measuring stick. That number is still going to be a positive number. It may not be a 10% like what we saw before. I think you show a number like increased by 16% or so for some areas on a year-over-year basis. We're probably not going to get that. We're going to see a price that is maybe about 5 or 6%, going forward. For the state in April, it actually increased by about 9%. But from this point on, probably will slow down a little bit. Now, the other thing that I think we need to clarify to the buyers is that the median price, we have been using median price. Helen, you have been using median price. The median price is the price right in the middle. Now, usually, if the sales mix is consistent, then your price appreciation is similar to your increase in median price. But when you are actually selling, if the mix of sales actually change, which means you're selling more higher price properties than last year, then you will probably see the median price increase, but not through price appreciation, but because you're selling more higher end home. So that's what happened in at least the last few months. The affordability issues, the affordability challenge applied more to the more affordable markets, because they can't qualify because of their lower income. So you see fewer low price property or affordable price property being sold. The higher end, you can still sell, you can still buy, because of many different reasons, wealth effect or whatever the reason is people in the higher price area can actually still buy higher end properties. But I do believe that the mix of sales probably will start coming down. Part of it is, you guys in the Bay Area, the wealth effect from the stock market does affect the housing market.
Absolutely.
The stock market, dropping by a lot in the last 2 months or so, especially for tech stocks, that actually could have an effect on how much people want to pay. So now, so the price, the number of sales in the higher price area probably will drop a little bit, and that will change the mix of sales. Now, I do believe, on the median price, it will slow down. It will still show a moderate, 5% increase or so throughout the rest of the year. So it is possible that we will see some areas dropping a little bit. But look at it from this standpoint, even if it dropped, let's say 5% or so compared to last year. Well, let's be a little bit more extreme. Even if it dropped 10% from last year, let's use an easier number to look at. 1.5 million for, say, I don't know which county has 1.5. I think Alameda maybe 1.6 or so. Let's say it dropped let's drop a 10%, drop from 1.5, 150,000 to 1.35. If you look at how it compares to last year or compared to 2 years ago, that actually is still a good number. Mm-hmm. Even though, of course, it is not as high as last month or 2 months ago, that number is still not a bad number. So the reason why I want to bring that up is back in 2007, 2008, or 2009, home prices dropped significantly. Some of you may be in the market at that time. It dropped significantly partly because people realized, oh, prices are dropping significantly. I don't have enough equity. I'm going to throw the keys back to my lender, my borrower. That's why prices drop even more. But even if it dropped 10%, for those who actually purchased in 2017, 18, 19, 20, they still have a lot of equity on the house. So the listings, they're not going to throw the keys back to the lenders or buyers. And as such, you're not going to see a lot of new listing being added to the property. I think some of the reason why your sellers may not be selling, part of it is you want to hold off. But think about why some of the sellers want to sell. They want to sell partly because they want to cash in. Some of the people will want to cash in so that they can buy their next house. If they don't think it's a good time to buy, they don't think it's a good time to sell unless they have more than one property. In the Bay Area, having more than one property is probably not that many people, because you have a $2 million property. If you have two, then you have to have quite a bit of equity. So I think that's one of the reasons people want to sell. People do want to sell, but they also look at whether they can buy. Mm-hmm. So now here's what I think might happen in at least the next couple of months. People are going to try to figure out what's going on, whether interest rates are going to continue to rise or not. They will realize later on that rates are not dropping. Prices may be slowing down, but not as much as they think. So they will start thinking about buying or selling again. I will be honest, it's not going to go back up to the level that we saw early part of the year or maybe late last year. It's going to be, we are going to see slower sales for the second half of the year. But price-wise, we probably will not see a significant drop. We probably will see some slowdown in growth. In 2023, we may actually see a little bit of drop, but probably not significant. That's again because we don't have enough supply.
This kind of reminded me of 2019, at least in the Bay Area over here, we have a little drop because like the interest rate did increase quite a bit at the time, closer to 5%. And all of a sudden we saw a drop in the demand. And I use this example all the time. We would have open houses. We have a lot of people coming in, but everyone I talked to, they were like, oh, we're going to wait until 2020 because we expect the price to drop. And of course, that never happened. But 2019, there are a lot of buyers who took advantage of that and they were able to buy at a little bit lower price. And then 2020 kind of took off. I feel like right now, this period of time, especially with going into summer where it is a little bit slower season, if you are buying and you are able to qualify still with that interest rate, definitely take advantage of that, because I think when the spring market come back, the price is going to come back up from the level that we are in right now. It may not come back up to the March, April time, but it would definitely, right now, this is the time where you can actually negotiate a little bit on your price.
I think so too. I think the other, another consideration to think about is, yes, you might actually see, a couple months or maybe even a few months of people holding off. But part of the reason why people are holding off, it could be because of their not having enough down payment.
Yeah.
Some people, and then after they realize, okay, well, the rates are not going to change that much, prices are not going to come back down significantly, and we are seeing more listings, and they see that, okay, well, there are some things that I really want to buy, and they save up enough down payment, I think they will resume some of the activity.
I
Now,
believe so too.
it is going to be, I will have to be honest, like I said, it will be slower compared to the first half of the year, first few months of the year, or maybe even second half of last year. Yes, it is going to be a little slower in terms of demand because the mindset might have changed, but we don't see a flood of listings coming in also. So that is going to continue to provide support for the price level.
Absolutely. So being the seller, you also need to be a little bit more patient. You cannot sell the property within the first weekend anymore, or even 2 weekends. It might stay a little bit longer. But just remember, many years ago, or a few years ago, I should say, or before this 2020, 2021, and the beginning of 2022 frenzy, we used to sell property. It takes about 3 weeks, 4 weeks too. So that is actually a normal market. We went over a little bit. I do want to bring up a couple of the comments from the audience. And Scott has said that people used to buy at 17+% a long time ago because they were afraid that the rates would go up to 21%. That is so true.
That is very true.
Yeah. And anonymous attendees said that the Ukraine-Russia war caused inflation. Well, how about the Fed's disastrous monetary policy, starting with Greenspan and continue with Bernanke, Yellen, and Powell of handing out money? And then I stop right there.
It does have, of course, the last 10 years, 15 years or so, that has been very easy monetary policy, at a certain point. But at the same time, if you look at it from the economic perspective, there are times that they have to keep the rates at a low level. But it is very true. Easy money does lead to a higher cost of, a higher increase in price level. That's very, very true. Tight supply is another reason. Whatever the reason could be, or variables could be, we did enjoy the 2% low inflation rate. Now that actually could lead to, slow economic growth, higher economic growth, but at a price that actually have to be paid now. This is very possible. We have been having quantitative easing. Those are some of the things that actually led up to, some of the inflationary pressure that we're seeing right now. Now, of course, all of those started, with a lot of things like, pandemic, and also, some of the uncertainties like the Ukraine-Russia war. Everything contributed to the high inflation, but nobody saw the inflation coming at this level. Now, how are we going to correct that issue? And whether we can be successful or not, that's hard to say. We'll find out in a minute. We'll find out, in the next, 18 months or so.
Somebody did ask another question, is that bringing up a point of population loss in California. How do you see this affecting the real estate market?
Good question. So yes, we did have population loss in 2020 and in 2021. Now, the loss in population in 2020 was partly due to people moving out of California because of flexibility to work from home, or move to another state. but also due to the fact that we actually have fewer foreign immigrant coming to the state because of COVID situation. Now, 2021, when we move forward to 2021, we actually saw a similar pattern, but not as much. So we are still losing population in California in 2021. And part of it also is because of, again, foreign immigrant, not having enough foreign immigrant coming to the US because of COVID situation. Now, going into 2022 and 2023, most economists and demographics projections predict that there is going to be an increase in population. The question is whether we have enough people to actually live in California and where they are moving to. Now, some people move from the Bay Area to Sacramento, to areas that are a little bit more affordable. But here's the thing, it is going to affect housing market when we have high home prices, people moving out of California. At the same time, keep in mind though, the population that we will be actually seeing an increase is probably in California, probably will see the age group between 26 to 39. And those people are going to be the one actually moving into the housing market, whether it be rental or whether it be to purchase a property, because of the change in the demographic group. Overall population, we probably will see either a flat in 2022 or a slight increase. But the real reason why we actually could feel optimistic about demand is because that group from 26 to 39, they are moving into their household established age segment. So that means they will need housing. Now, do they need rental housing or purchase housing? It really depends on whether, which is more affordable.
That's a good point. And also, either way, the supply is still, or I should say the housing in general, supply of housing is just so short compared to the demand here right now. And we're just not building enough housing supply. But that will be another topic to talk about as well.
Exactly. Now, let me show you really quick, the commercial side. I apologize again for not being able to move a little faster. I tend to talk a little longer, as I mentioned. So what about okay, so for the residential side, as I mentioned, I think we're going to see some slow sales and demand in the second half of the year. Prices, I think it will still show a year-over-year growth rate, but at a much more moderate level. We're going to be below the peak level for sure as far as price, but we're not going to see a flood of supply, like I mentioned. What about the commercial side? I briefly mentioned about what happened. When you have an issue when you have a housing affordability issue on the side, on people who want to purchase, when many people may not be able to purchase because of higher rates and higher price, but they still need to, find a place to live, where do they go? They go to the rental market. And you have been seeing multifamily and apartments, average rent actually has gone up, 15%, 16% in many areas. Is that going to continue? Well, think about this. For apartment and multi-units, we actually don't have enough and we need to build more. But at the same time, we are having some raw material and labor supply issue in the construction industry as well. And that's why, even though we started building more, it will probably continue to build. The other thing is, so as far as the average rent is concerned, probably will be kept up. The other thing is, there is also going to be demand for rental units or multifamily. I should say there will be interest in owning multifamily and apartment units. Why is that the case? Take a look at this chart right here. Apartment, typically, if you look at this trend line right here, this is the red line here is the rate of increase in price, rate of increase in rent, rate of return compared to the inflation rate. Take a look at the stark line, that's the inflation rate. The red line is the rate of return of apartment. They're usually in line with each other. And if you look at multifamily and CPI, multifamily and other units, the multifamily or apartments actually tend to have a higher rate of return compared to other units. So this is a great, owning an apartment or owning a multifamily is actually a great way to hedge against inflation. especially since the stock market actually, have not been doing very well. So if you have a property rising at 15, 16% in terms of average rent, and the value of that property is increasing, that actually is one way to hedge against inflation. So there will be demand, but of course there are some property type that may not be as great. Retail may be a little weak because of the economic uncertainty. Office, a lot of people actually work from home, and we have a lighter demand for office. And office average rent, you see in the next slide, it has only been increasing by about 1 or 2%, and retail also a slower number. And they tend to have a longer term of lease compared to apartment, so you can't really adjust rates. So here are the rising asking rents in April. This is based on NAR's number. 9.4% for apartment. If we have an 8.3% inflation rate, that trumped the inflation rate. Now, office and retail, of course, they're a little bit lower, 1.3 and 3.9. Industrial property, an increase of 11.2%. So these two type of properties are good hedge against inflation. And there have been some positive net absorption so far for the first 3 months. And here are the outlooks from NAR. They believe that as far as, so we have apartment, industrial, office, and retail. They believe the rent growth will continue to grow by actually double digit in 2022 and 2023 for as far as average rent. And that's why price growth actually will increase by double digit as well. Take a look at industrial outlook. It actually show a double digit in 2022 and close to double digit in 2023 as far as average rent. And take a look at the price, pretty consistent with the average rent as well. And retail and office, they're a little bit weaker, but right now, that's what the economy tells you. So I just want to show you the commercial side to give you a sense of what's going on. With that, here's the concluding remark. Inflation is a real threat. We do have some economic recession risk. It's on the rise. Rates are going to continue to rise, but probably not as high as, as fast as what you have seen. And as far as home sales is concerned, yes, it's going to slow down with rates climbing. And supply is going to continue to be tight, even though it's going to improve a little bit. And that's going to keep price from falling. It will fall from the peak, but it probably will show slow growth for the rest of the year. Now, next year, 2023, we may actually see some fluctuation depending on whether the economy is going into a recession or not. But I don't think, we will see a price dropping by too much like what we saw in 2009 or 8 or 9. With that said, I'm sorry for running overtime by a lot, but hopefully I answered most of the questions.
Thank you. And just to confirm, that was the numbers that you gave regarding the CRE, those are California data, or is that national data?
That's national number.
National number. Great. That's great. And then just a reminder, like rental growth, we also see similar effect in the single family housing if you're renting those out as well. And apartment, we have so many buyers, so many investors interested. It's just that same thing. We don't have enough inventory for multifamily because landlords also want to hold on to their building right now, knowing that the rent has been going up. With that said, again, thank you so much, Oscar, for being here. Really appreciate you share so much data, and I'm so glad that my projections is in line with yours. So really appreciate it. Well, thank you again, Oscar, and thank you everyone for joining. I'll see you next month. Thank you so much for watching our YouTube channel. And don't forget to subscribe to our channel, like our videos, make some comments, because we're going to keep you posted on the most updated real estate news, housing market data, and also real estate tips and advice from all over the real estate industry. So thank you so much for watching, and I'll see you next time.